Happy Monday. It's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of March the 14th. Hope everybody had a fantastic weekend. It was beautiful weather outside. Spent time with friends and family, rode the bike a little bit, and just enjoyed a few days off. So let's talk about what happened last week and what's going to happen this week. So last week was an ugly week for mortgage rates, 160 plus point sell-off in the bond market, meaning that the basis points got worse by 160 basis points, meaning that money flowed out of that bond market, it went somewhere else, and rates went up. And it was one of the largest sell-offs in a week that we've seen in quite some time. And this really has been the trend for the last many weeks, is those rates have been creeping up. We've been talking about this every week. Really, since October of last year, we've seen rates go up, and they've been going up at an accelerated rate since January. So I'm going to show you a chart so you can see this in a visual way, the impact of the mortgage-backed securities market and how it really drives those interest rates. So when mortgage-backed securities are traded, that's where mortgage interest rates are determined in the bond market. And when money flows out of that bond market, mortgage rates go up. And if you look at this graph, this is a representation of the mortgage-backed securities market. On the right side is today. We can see that's March 15th or 14th. And on the left side is back in March of 2019. And when we see upward movement, if I use my drawing stick here, when we see upward movement here, that means mortgage rates are getting better because money's flowing into the bond market. When we see downward movement, as we've seen in the last 2.5 months, we see money flowing out and mortgage rates going up. So we are at a level now back here on the 14th that is approaching where the rates were at the height of the pandemic. This big volatility here that my cursor's over is showing March of 2020. In a couple weeks, the market just went crazy because everything started shutting down 2 years ago. And then the Fed stepped in and started buying billions of dollars of mortgage-backed securities, putting money in that bond market, which drove rates down. And then we were in a wonderful rate environment, as we all know. We all took advantage of it. It's one of the things that's been driving this hot real estate market is mortgage rates are down. Everybody refinanced their house. And then October of last year, a lot of this changed because the Fed said, hey, we're not going to buy those mortgage-backed securities anymore. That's the first thing they announced. We're going to get out of the bond market in essence. And also inflation is out of control. We've been telling you it's not that big of a deal. And that's what they had been doing in 2020 and 21. And now we know that they just weren't telling us the truth. They were not accepting the fact that inflation is at a 40-year high. And we'll talk about that in a sec. But I wanted you to see that really since October, 1st of November of last year, we've just seen the bond market start to deteriorate, and then it's accelerated in January because the Fed said, we're not going to stop buying those mortgage-backed securities in June. Now we're going to stop buying them in March. And that really caused a drastic sell-off on the bond market just about every week. So let's go back to talking about what really happened last week and why there was such a huge sell-off. The primary reason was inflation. Inflation is over a 40-year high. The CPI, the Consumer Price Index, came out last week. Again, numbers off the charts. It's the highest readings we've ever seen since we've been tracking this. And inflation is the death of rates. When inflation is up, rates go up. And if you think about it like this, if you have $1 million in bonds and the yield on those bonds is 4% and your inflation is 1%, you get a 3% rate of return. On the other side of that, when the yield on bonds is 4% and now inflation is 3%, the investor gets a 1% rate of return. So what do? They raise the yield on those bonds, which is basically a rate, so that anybody investing in bonds can get an acceptable or a rate of return that would entice them to invest. And so that yield has just been going up. The Consumer Price Index, again, is one of the key measures of inflation. And keep in mind, that Consumer Price report we got last week was based on information that was about a month or two 1 or 2 months old. It always happens that way. So that's when oil was at $75 a barrel, not when oil's at 120. So that CPI is going to get worse. Next month, it'll be worse the month later because oil has just gone crazy, as we all know. Gas prices are just insane. So what are we looking at this week? And how is it, the three things that are going to affect rates? So we're really looking at the Fed, we're looking at world politics, and we're looking at inflation. So the Fed's meeting this week. They start the meetings tomorrow and they end the meetings on Wednesday. And it's a big, big meeting because they're really going to talk about their rate policy and their economic projections. Everybody knows the Fed's going to raise the rate on Wednesday 0.25%. It's going to happen. They've announced this. They've basically guaranteed that rate's going to go up. And so that's already been priced into bonds. We already know that the bond traders have already calculated that rate increase. But the second thing they're going to talk about is economic projections. And this is a big, big deal. What are they going to say? Are they going to say the economy is going to get better, going to get worse? Is inflation going to get under control? Is it not? The Fed has a key inflationary rate of 2.5%. It's less than half of what inflation actually is. So they're not even being realistic on their inflation projections. Will that change? And the bond market hasn't calculated in what is going to be said on these economic projections. So that Fed meeting is a really, really critical meeting this week. World politics. So there's two things really happening in the world. We know the war in Ukraine has disrupted so many things in the economy. There's a fourth round of talks that are happening, which is positive for the market, for the stock market, not good for bonds. So if these talks produce anything positive, as far as a ceasefire or maybe a de-escalation of the war effort or what's happening over there, that's going to be negative for rates because it'll be positive for the economy generally. If these fall apart, if there's bad news, China's asked or Russia's asked China for economic help. And so if these talks fall apart, then that's going to be better for rates. But it's so much volatility, we really don't know how that is going to play out. The second thing is China. China just shut down a huge province, 17 million people, which this province is like the Silicon Valley of China. They make a lot of iPhone products are made here, chips, a lot of things are made here. So this is going to cause more of a supply chain interruption in products that we've already seen worldwide. This is just going to exacerbate the problem we have of being able to produce things because we're waiting for products that we just can't get. So China still thinks the pandemic is a big deal, and they're reacting appropriately that they think is appropriate. And then the third thing is inflation. The PPI, the Producers Price Index, is coming out this week. Now that's one of the really favorite key measures of inflation for the Fed. We expect it to be as high as it's ever been. Again, these numbers are a couple months old. So as we get the next one next month, or 1 month after that, we expect these numbers to be higher. But this is going to be a bad number. We expect it's going to be worse for rates. So just a lot of volatility. Most things really are pointing to higher rates this week. There's a few things pointing to lower rates. We're watching the market very carefully. We're starting the week floating. We really probably don't expect to get locking. We don't expect to get out of a locking position. We've been in that position for a month. And thank God we've been there because rates have just steadily increased. Now, one tip here, we can't change the rates, we can't control them, we can't change the market, but we can impact our buyers and our sellers and how they interpret the market. We can educate them. Rates are still very, very low. I talked to a borrower over the weekend, made an offer, got an offer accepted on a house, gave him the market rate, and he was able to say, gosh, that wasn't that bad. My parents' rates were a lot higher. So it's all perspective. We really need to educate them that locking is the best thing to do. Rates historically are still very, very low. Anything under 6% historically is a low rate. It's hard for people to see that when they were used to or heard about a 3.5% rate that's just not around anymore. So if you have any questions on rates, the market, please let me know. If you know somebody who can benefit this video, please forward to them. And I'd love to hear your comments. Have a wonderful, productive week, and I'll talk to you next week. Bye-bye.